So now let's look at how do we create money. There are a number of ways we can create money. So we can print banknotes or manufacture coins. So our central bank, the Bank of Canada, is the only one who is legally allowed in the country of Canada to print banknotes and manufacture coins. Same thing in the US, the Federal Reserve is the only one who can give authority to print banknotes or manufacture coins. And then they have the Bureau of Printing and Engraving who actually carries it out. But it's the Federal Reserve in the US and the Bank of Canada in Canada who determine whether or not banknotes get printed and coins get manufactured. So legally, there's only one entity in each country who can do that. And that's how we maintain the money supply. We can't just make our own coins and photocopy our own $10 bills. Okay. But when we look at printing banknotes or manufacturing coins, only 3% of all of the money in Canada is in the form of currency, coins or notes. We said the majority of our money is actually electronic. And so we need to look at then how we create money electronically. Okay. Well, we can change the money supply. So we're looking at here, when we talk about creating money, we're talking about changing the money supply. We can change the money supply through bank lending. We also change the money supply with our fractional reserve banking system. Because by a fractional reserve banking system, what we mean is that our banks have to hold a certain amount of money in cash. They can't lend that out. And the Bank of Canada changes what that fractional reserve is, how much has to be held as cash. So when you change how much the banks have to hold as cash, it changes how much they can lend out, and it's the bank lending that changes the money supply. So we're going to look in just a moment about how bank lending changes the amount of money in circulation. The last way to create money is to do what is called quantitative easing. And we're going to look at quantitative easing after we look at bank lending. So let's dive into those. So each time a bank issues a loan, it is actually creating money. And that's because that money is now in two places, right? You deposit $100 into your checking account, okay, demand deposit, and your bank statement says you have that $100. Well, if the bank lends out money, it is lending out that money that you just deposited, and it lends it out to someone else. So now someone else's bank statement also says they have $100. So banking is the only industry where you can legally sell the same good more than once. Right? Where we have $100 in your account and $100 in someone else's account, and really it's the same $100. But by lending then, we've actually increased the money supply because we've taken the $100 and now we've turned it into $200 if we're fully lending out the $100 you deposited. Now, when we talk about bank lending changing the money supply, it's important to know the different types of banks that we have in Canada. Because when some banks lend, it is considered to be part of the money supply, and when other banks lend, it is not. So we need to separate out the different types of banks in Canada. So we have the Bank of Canada. That's our central authority, the one that has the authority to print banknotes and manufacture coins, and the one who is ultimately charged with maintaining the money supply. Okay? And then we have chartered banks. Chartered banks, if they're federally chartered, have to get approval from the Bank of Canada to go into existence. And the Bank of Canada requires that a certain amount of their money be held at the Bank of Canada. So chartered banks, federally chartered banks, fall under the authority, the responsibility of the Bank of Canada, which is why whenever a federally chartered bank lends money, it creates more money in our money supply. Okay. So let's talk about who is a chartered bank. Well, there are actually 32 what we call Schedule I banks in Canada. But really, let's focus on the big six that we will know. So the big six federally chartered banks would include, well, you tell me. What are the big six banks in Canada? We have Royal Bank, we have TD, we have Scotiabank, we have BMO, we have CIBC, and there's one more, which is the National Bank of Canada, which is in Quebec. So when we think about federally chartered banks, really these are the banks that we're thinking about. There are other banks, as I said, there were 32 Schedule I banks, but the other ones are much smaller and much more recently approved to be a federally chartered bank. So whenever Royal Bank, BMO, TD, whenever they lend money, it creates money in our money supply. Now, the reason that these banks, when they lend money, it creates money in the money supply is because they are accountable to the Bank of Canada, and the Bank of Canada is the one who monitors and controls the money supply. And so because you have to have Bank of Canada approval and you are regulated by the Bank of Canada to be a bank, then you are part of the money supply. Well, let's think about some other banks that we know of in Canada. So in Alberta, for example, we can think of ATB. Well, ATB is a provincially chartered bank. Not a federally chartered bank. So in order for ATB to become a bank, they fall under the authority of the province of Alberta. Okay? And it's the province of Alberta who's responsible for ATB, whereas Royal Bank and TD are accountable to the Bank of Canada. Now, the impact that it has on these banks, besides the fact that who regulates you, who controls how much cash you have to hold, things like that, the other impact is what if your bank runs out of money? Who bails you out if your bank goes under? Well, if Royal Bank runs out of cash, they can borrow money from the Bank of Canada. If ATB runs out of cash, they have to borrow money from the province. So it is who is insuring you. And when we talk about FDIC, okay, we're talking about the federal insurance for banks like Royal Bank and BMO. If ATB runs out of money, then to guarantee the money that's in your accounts with ATB, that's insured at the provincial level. But ATB is not controlled directly by the Bank of Canada and is therefore, when they lend money, not part of our M1 money supply. Okay. Other things that are not part of the money supply are the near banks. So near banks are not chartered. They are the savings cooperatives and credit unions. So here in Alberta, we have Service Credit Union. And so when Service Credit Union lends out money, which they can, it does not add to the money supply. It doesn't add to M1. And that's because near banks are not accountable to the Bank of Canada. They have to separately insure themselves, so privately insure themselves. If, for example, they ran out of money, they went under and they needed to pay people for the loss of money from their demand deposits, their checking accounts, they wouldn't be bailed out by the Bank of Canada. They would have to be privately insured. Okay. They do get private insurance, otherwise there would be no way they could compete with the Bank of Canada and the chartered banks, but they are not part of the money supply when they lend. All right, so let's look at how lending creates money. All right, so we have our demand deposits. That's the money you put into your checking account. And then from the money you put into your checking account, we have a target reserve. So the target reserve is the portion of the demand deposits that the bank must hold as cash. They cannot lend it out. And with our chartered banks, some of that target reserve is actually held at the Bank of Canada. So there's a target reserve ratio. The target reserve ratio is the percentage of demand deposits the bank is going to hold as cash. So our target reserve ratio then is really the target reserve, the amount held as cash, divided by your demand, or the total demand deposits. Okay, so target reserve ratio is the amount or the percentage that has to be held as cash. So the question is what are the reserve requirements? The target reserve ratio is set by your central bank. Okay. So if we look at the target reserve ratio for the US, the target reserve ratio in the US is 10%. So 10% of the money that's put into checking accounts has to be held by the bank as cash. So then the excess reserve, that's the amount that banks can lend out, is the rest. So if $100 gets deposited into a checking account, so a demand deposit, in the US, $10 of that would have to be held as cash, and the other 90% of $190 could be lent out. So the excess reserve is what banks can lend. Well, let's look at some other countries. What would their target reserve ratios be? In 2016, China's target reserve ratio was about 17%. And this is actually down from previous years where it was over 20%. So tell me, why would we lower the target reserve ratio? Well, if you lower the target reserve ratio, then banks hold less money as cash, which means they can lend more out. So if your ratio goes down, then your lending will go up. If your ratio goes up, then the lending goes down. So the central bank, so in Canada, the Bank of Canada, we could change the target reserve ratio to change the amount of bank lending. And since we just talked about how bank lending adds to the money supply, because if there's $100 in your checking account and the bank is lending out, let's say, 50 of that, the money supply is the $100 in your checking account, plus now there's an extra $50 that didn't exist before. So when lending increases, the money supply is also going to increase. So we can change that target reserve ratio to change lending, to change the amount of money in circulation. All right, so based on that then, what do you think the target reserve ratio is for Canada? What do we have as our target reserve ratio? Well, the target reserve ratio in Canada is actually 0%. What? Does that mean banks in Canada don't hold any cash? No, they hold cash, but the amount they hold as cash is up to them. Okay, so first, why would they choose to hold cash? Well, you choose to hold cash because if suddenly a bunch of your customers came to the teller or the ATM machine to pull out money, you need to have money. If your customers go to the tellers and the ATM machines and there is no cash, this is what we call a bank run. We saw bank runs during the Great Depression in the 30s, right? People concerned that their money wasn't going to be there. They panic, they go to pull it all out. Well, the problem is that the amount of money that's in the bank doesn't match the total amount of money that it says on people's financial statements, right? Your bank account says that you have, let's say you have $20,000 in savings. Well, all the other people who bank at your bank also have bank statements that say how much money they have. The bank doesn't actually ever have all that money on hand because they lend it out, right? Increasing the money supply, but we're not actually increasing the amount of currency, of coins and banknotes. So a bank run is when everyone goes to pull their money out and the bank runs out of cash, which is why our federally chartered banks can borrow money from the Bank of Canada. They can be bailed out if they don't have enough money on hand. But to help protect for that bank run, Banks hold a certain amount of cash on hand so that when people go to tellers and they go to the ATM machines and they go to pull out some of their money, they can do it. Okay? But banks, because they make money by lending, really couldn't provide all the money that everyone has in their accounts simultaneously. Now, why would we set our target reserve ratio to be 0%? Right? Why wouldn't we make our banks hold more as cash? Well, we just said that if you lower the ratio, you increase lending and you increase the money supply. Why would we want there to be more lending and more money in circulation? Well, if it's cheap to borrow, if there's lots of lending happening, then we're more likely to borrow money and buy the house and buy the car. Businesses are more likely to borrow money and expand that new location, upgrade their equipment, right? New capital. So the whole reason for lowering the ratio to increase lending and increase the money supply is to increase aggregate demand. That is to get our economy spending and get the economy growing. So we have a target reserve ratio at 0% to encourage our economy to spend, to borrow, to grow. Now, let's look at how lending creates money and what is called the money multiplier. Okay. So we said that excess reserves were the amount of cash that the banks could lend out. So remember, you put money into your checking account, the demand deposit, and part of that has to be held as cash. That's the target reserve. And the rest is the excess reserve. So our money multiplies when banks lend. So we have what is called the money multiplier. The money multiplier is the increase in the total deposits that occurs from when you have a single new demand deposit. It's going to have this multiplicative effect, right? You put $100 into your checking account, demand deposit. The bank can lend out a portion of that. That portion gets lent out. That person puts that into their demand deposit. A portion of that gets lent out, and it has this ripple or multiplicative effect. So we increase the money supply by this money multiplier. So let's look at how this works. Let's suppose that in our economy we have target reserves of 40,000 and demand deposits of 100,000. So we can find the target reserve ratio by taking the 40,000 that has to be held as cash and dividing it by the total amount in the demand deposits, that's 100,000. So the target reserve ratio here is 40%. Now, you deposit $100 into your checking account. Okay. So we take that $100 and 40% of it must be held as cash. So $40 becomes target reserve and the rest is excess reserve. Well, if the rest is excess reserve, then that means that your bank can lend that $60 out to someone else. So our money supply is increasing. There's the $100 that was in your checking account, but now the money supply has increased because $60 has been added to someone else's checking account. Right? So we're already seeing our money multiply. Well, that $60 gets lent out and it gets put into someone's checking account. All right, well, if you put it into someone's checking account, then that bank has to hold a portion of it as cash. So 60 times 40% has to be held as cash. 60 times 0.4 is 24. So 24 has to be held as cash, and the remainder is excess reserve. So 60 minus the 24 gives us 36, and that 36 can then be lent out to someone else. So the bank lends the $36 to someone else. Okay, and let's say that they're in a different bank. Well, if they're at a different bank, they're still going to put it into their checking account, and they're still bound, because it's our entire banking system that has a set target reserve ratio. So of the 36, 40% of that has to be held as cash. Right? So $14.40 has to be held as cash, and the rest becomes excess reserve. So 36 minus 1440, there's 2160 in excess reserve. And the 2160 in excess reserve can be lent out. All right, so somebody else gets a loan of 2160, and they put that money into their checking account. Well, if they do so, then of that 2160, the bank has to hold 40% as cash. That's what, $8.64. And the rest of it becomes excess reserve, so 2160 minus 864. So 1296 is excess reserve, and 1296 gets lent out to someone else. All right, well, let's keep going. So 1296, if that gets deposited, the 1296, 40% of that has to be held as cash. So that's what, $5.18. And the rest becomes excess reserve. So 1296 minus 518 is 778. And the 778 gets lent out. Okay, 778 gets lent out. It gets put into someone else's checking account. The bank has to hold 40% of that. So what is that, 311 as cash. And that leaves, what, $4.67 as excess reserve. That $4.67 gets lent out. Okay. And that $4.67 gets put into someone's checking account. 40% of that has to be held as cash. So that is, what, $1.87. And if $1.87 has to be held as cash, the rest becomes excess reserve, which is what, $2.80. The $2.80 gets lent out. Of the $2.80, 40% has to be held as cash, so what is that, $1.12? And the rest becomes excess, so $2.80 minus $1.12 is $1.68. $1.68 gets added to the money supply because it gets lent out, and that gets deposited into someone's checking account. All right, so then we have $1.68 times 40%, so 67 cents has to be held as cash. The rest gets lent out, so what is that, $1.01? All right, so $1.01 gets lent out. That $1.01, 40% of that has to be held as cash. What are we at now? 40 cents. The rest of it becomes excess reserve. Okay, so we have what, $1.01 minus 0.4, so 61 cents. That 61 cents gets lent out. Okay, of the 61 cents, 40% has to be held as cash, so that's 0.24. And that leaves 37 cents to be lent out. So 37 cents. So you can see how we can keep going all the way down until there's only a penny left to lend out. Well, let's take a moment and let's add up all of that money that has been lent out plus the initial $100. So we're taking our, let's do that here, 100 plus 60 plus 36 plus 2160 plus 1296 plus 778 plus 467 plus 280 plus, 168 plus $1.01 plus, what do we got, 61 cents plus 37 cents. And if you kept going, you probably have a couple more pennies there too. And you find this total is $2.49, about $2.49.48. Okay. So what we're finding here is that we had $100, and $100 became $249.48 in terms of the money supply. So our money multiplied through bank lending. $100 into a demand deposit or a checking account became $249.48. Well, we did a lot of number crunching calculations to get there, but there's also a lot easier way to figure out how much our money will multiply. We can use the formula for the money multiplier. The money multiplier looks at the change in deposits divided by the change in your target reserves. So we can find the money multiplier by taking 1 divided by the target reserve ratio. And in the example that we just did, our target reserve ratio was 40%. So let's do a quick calculation of 1 divided by 0.4, and we get 2.5. So what does the money multiplier of 2.5 tell you? It says that if we put $100 into our checking account, so $100 demand deposits. So a new deposit of $100 becomes 2.5 times that $100, or it becomes $250 in the money supply. Well, let's compare that to what we just calculated. We found that $100 deposited into our checking account became $249.48. Well, why didn't we end up at $250? Well, we didn't keep going and get every single penny that was lent out. If we would have kept going, we would have ended up at $250. So you can see how the fact that you put money into your checking account, a portion of it gets held as cash, but the rest of it gets lent out. And so that begins to multiply the amount of money in circulation, because your pieces of your $100 are now in lots of different people's checking accounts, and that means they can spend that money. So we have multiplied the money supply. So the money multiplier, we find it by doing 1 divided by the target reserve ratio. So $100 of demand deposits became $250 in the money supply because our multiplier was 2.5. If our target reserve ratio was 5%, so we would do 1 divided by 0.05. 1 divided by 0.05 is 20, and there $100 deposited into a checking account would become 20 times that $100. So our money supply would go from $100 to $2,000. So we can look at how much the money supply increases from looking at our money multiplier. And it's really dependent on the target reserve ratio. So remember, we just said that if the target reserve ratio, if our ratio goes up, well, if we go from a target reserve ratio of 5%, which is what we have here, to 40%, which is what we have here, notice the multiplier went down. At a 5% target reserve ratio, our multiplier is 20, and at a 40% target reserve ratio, our money multiplier is 2.5. So if the ratio goes up, the multiplier goes down, and the rate at which our money supply is increasing goes down. So if you want to grow the money supply and increase demand and get people spending again, you want to get that ratio down so that Banks can lend out more money, people can borrow more money, and then they can spend that money. Well, while we're on the topic of the money multiplier, let's look at what would impact the money multiplier. Okay? So we just said that if you increase, there's an increase in your target reserve ratio, then that's going to make your multiplier go up or down. Increase the target reserve ratio, it makes the multiplier go down. Well, what if people just want to hold more cash? If people want to hold more cash, then there is a decrease in the amount of demand deposits. If we're not putting as much money into our checking account, then banks don't have as much money to lend out. And so this will also cause the multiplier, and therefore the money supply, to decrease. So we have to put money into our checking accounts, demand deposits, in order for banks to lend out a portion. We also have to be willing to borrow money, because if there's a decrease in the demand for loans, then even though there's sufficient amount of money for banks to lend out, and the target reserve ratio is adequate for them to lend money out, if we're not borrowing, then the money supply cannot multiply. Right? We have to be able, we have to borrow money in order for the money supply to increase. The last thing I want to look at is what if there's a decrease in the number of creditworthy applicants? All right, so there's plenty of money in the demand deposits and checking accounts. The target reserve ratio is low so that banks can lend money out. There's demand for loans. People want to borrow money. But if we're all high risk, then banks are more reluctant to lend money out. And so there's less loans happening, and the multiplier in real life will then go down. So where the money multiplier, when we calculate it, is just 1 divided by the target reserve ratio, there's more to it that can impact the multiplier. We have to put money into our checking accounts, we have to demand loans, and banks have to be willing to give us loans. In order for bank lending to add to the money supply, we have to put money in our checking account, we have to borrow money, banks have to be able to lend money, that is, they can because they don't have to hold it all as cash, and they have to be willing to. All of those will impact the multiplier.